Provisional income. It is the calculation that the IRS uses to determine how much they're going to tax your Social Security. So let's jump in and learn more about provisional income.
The truth is, you need to protect yourself. First, I'd like to introduce Senior Investment Manager and founder of Inception Financial Services, Edward Shue, who grew up in the Midwest, became a Marine Corps engineer, and then turned financial advisor. And he's obsessed with teaching people how to engineer a more reliable retirement. Hey, Edward, glad to see you join us today.
Thank you, Robert. I appreciate it as always. And as a Marine Corps veteran, I like the reference to A Few Good Men there. And although I think everyone here can handle the truth.
Yes, I think so too.
A lot of people didn't know that the IRS wants to tax our Social Security, so they're going to try to figure out a way to do that. And provisional income, what counts as provisional income is half of our Social Security, any ordinary income, which is going to be W-2s, distributions from our 401ks and IRA plans, any dividends or capital gains from other investments that are in that taxable bucket. And then interestingly enough, this last one, non-taxable interest, refers to municipal bonds, right? Municipal bonds, a lot of people think, are a truly tax-free vehicle. However, income that you get from municipal bonds is counted toward the taxation of our Social Security. So it's important to understand what counts as provisional income.
So let's take a look at the calculation. And again, we won't get deep into numbers, but just kind of a brief overview.
Sure. So the things to really pay attention to on this slide are, for a single person, here's the thresholds. If you exceed 25,000, they're going to tax up to 50% of your Social Security. If you exceed 34, they're going to tax up to 85%. For married couples, it's 32 and 44 with the same percentages for that threshold. So what we can see is if we have 54,000 in Social Security, plus all of our income comes from taxable resources, now all of a sudden, 127,000 becomes taxable. 27,000 of our Social Security becomes taxable. If we exceed that threshold, now all of a sudden, 85%. Now we're going to pay taxes on 46,000 additional in income. And what we found is those individuals that have their Social Security taxed can generally run out of money anywhere from 6 to 8 years sooner. Now, if we go through the process of calculating the correct amount for conversions as well as to go into LIRP, now all of a sudden what we see is if we get the right balance, almost all of our income of that 100,000 is going to come from our Roth conversions as well as our LIRP, leaving us with only 5,000 in taxable. And there's other calculations that go into that as well. So now all of a sudden we're below the level and the threshold of our provisional income. So now our Social Security comes to us tax-free.
Thank you for joining us today. We hope that you learned something new. And if you did, like, comment, and share. If you'd like to learn more, make sure that you subscribe to our YouTube channel so that you'll get notifications of the latest videos. And you can check out our complimentary resources below for more complimentary education.